25 seconds away from the opening bow this morning. Good morning to you all. We're almost there. A long weekend in the States just around the corner. Futures are unchanged on the S&P. They were positive overnight off the back of a scheduled meeting between Secretary Blinken and Minister Lavrov. The tone since then, we've unwound a lot of it. Unchanged on the S&P, just about positive on the Nasdaq. There's the opening bow. Switch up the board and get to the bond market. 10-year yields come in 2 or 3 basis points to 193.72. Euro dollar 113.46. We're negative there, a tenth of 1%. In about 90 minutes from now, we'll hear from President Williams of New York, then on to Brainerd later on this afternoon. The Fed speak front and center for a lot of you, I know. Curious this one, crude 89.47, a break in 90 to the downside, negative 2.53%. Call it negative 2.5. On the week, the biggest weekly loss of the year so far. And let's be fair, a weekly loss for crude right now is tremendously rare. At the opening bow, then about 30 seconds in, we're just about positive on the S&P by almost a tenth of 1%. Energy, the big loser this morning, down by a little more than 1%. Information technology getting a bounce, a kick higher from yesterday's big losses, up 0.4% on IT. Let's get you some movers. Let's get to Abby.
Hey, John. Well, the earnings season continues on, even though perhaps less well-known names. But one big name is helping that S&P 500 with that fractional gain. And I'm talking about Deere. Shares are popping higher after they put up a very big beat. And more importantly, actually, now the stock is lower. That's interesting because it had been sharply higher, but now trading lower. It was a great quarter, though, and they boosted the outlook once again on farm demand. We'll have to be looking into what's causing that turnaround, that decline to the downside. It could be some of the other earnings movers, maybe the sentiment. It's hard to know. In terms of some technology names that are moving to the downside, let's take a look at Roku, absolutely plunging. They missed and their outlook disappointing, blaming it on the supply chain, which is interesting given the fact that only 19% of their revenue comes from goods sold. Shake Shack down 13%. They put up an ugly quarter, huge miss, the outlook disappointing, and their guidance really is signaling trouble ahead to some. And then finally, DraftKings, also another ugly name here. Users fall short. Their forecast is for a loss. They're not seeing a profit until 2024. So overall, a little bit of a rough day for these earnings movers, and I will be looking into Deere and what caused that turnaround. John.
Abby, thank you, and we'll touch base with you before the show on that too. Thank you very much. 2 minutes in, taking a look at crude as well. Brent right now, 91.17, WTI, 89.59, heading for the first weekly decline in 2 months. Katie Lines, it has been a while.
It has definitely been a while, and there's a lot of stories playing into this, shall we say, especially on the geopolitical front. On the one hand, we continue to monitor risks around the Russia story and energy output from that big oil producer. On the other hand, there is the issue of Iran and the potential return to a nuclear deal and more supply coming onto the market from that country. So it's a lot to weigh. Obviously, crude moving to the downside this week, but we have to consider how far we have come already in 2022. We started around $75 a barrel on WTI. We're now in and around 90, up about 20% year to date, and it's really across the energy complex. You have natural gas futures up about 24%, and all of that adds up to big gains for the energy sector as a whole. It is far and away the best performing in the S&P 500 this year, up about 22%. So oil prices helping energy companies, but it is energy players that are also propping up oil prices in that they are still keeping supply constrained even in the face of this demand recovery. We know OPEC Plus has been very slow to add barrels back onto the market, maintaining that steady 400,000 barrels a day increase every month. But it's not just about the cartel. It's about this shale patch as well, which actually the U.S. was the largest oil producer in the world in 2020, about a 20% share. And it used to be a drill baby drill story when it came to shale, John. A lot of investments in production, pumping more crude, more production capacity. But that has now shifted to a story of discipline, controlling costs, returning capital to shareholders. It's less about pumping as much as you can. The question really surrounds how long that is going to be the story if we see oil prices continuing to climb. What happens if we hit triple digits? Is it just too enticing to start drilling more, John?
Kelly, thank you. And can I just say, wonderful interview yesterday. Just fantastic. Thank you so much for that. Alongside Guy Johnson with the Pioneer CEO. Take a listen to what he had to say about crude. 100, 150, 200. What would bring him back?
Regardless of whether it's $150 oil, $200 oil, or $100 oil, we're not going to change our growth plans. Even if the president wants us to grow, I just don't think the industry could grow anyway.
Back with us, Jill Carey-Hall, Jack Caffrey, Sri Sankaran. Jack, first to you. You talked about the cyclicals briefly. Energy's been a massive winner for this year. Is that music to your ears when you hear someone in a shale patch saying, I don't care what it gets to, 150, 200, we're going to be disciplined?
this is an industry which has historically struggled with its discipline. And so to the extent that they continue to talk discipline, that's a very powerful statement. They also recognize that there's been tremendous pressure on, if you will, eroding demand growth into the future. And to the extent if you were in the political sphere, higher prices actually might encourage people to make that transition that much faster. But they also, I've had some concerns if we've had a labor force that could have a housing boom, an infrastructure boom, and would you have workers for energy? I think what you're hearing from the energy companies is we don't want to incur higher costs at this point in time. And I think lastly that there's some concern how much of this current oil price that we've seen has got a geopolitical bid to it, and that could ease. I think when you look at that gap between oil prices and natural gas prices, it suggests that there's some larger than usual amount of geopolitical risk in the oil market, which is in some of the more domestically oriented energy sources such as natural gas.
So even if we do strip out the energy conversation for a moment, and Jill Kerry-Hall, we just talk about prices and where the pricing power is, your world, the small caps, do you think there's more pricing power there than what you're seeing maybe concentrated in the S&P 500?
Yeah, surprisingly, when we've looked back, historically, small caps have fared very well in periods of elevated inflation. We've seen that their margins have surprisingly been less negatively correlated with some of the inflationary forces like labor and CPI than large cap margins. And we've continued to see that show up in recent earnings seasons. So when you look at the mentions of pricing power on earnings calls, you actually saw more positive trends mentioned by small cap companies than large cap companies. So yeah, I think this is a space that we continue to like, that we are expecting inflationary pressures to ease as we move throughout this year. But certainly labor is something that has been a risk, especially to more labor intensive areas of the market. So pockets of consumer, pockets of industrials and healthcare. For the S&P 500, consensus is expecting that we could see a return to record margins this year. So that looks a bit optimistic to us and is one of the reasons we've been below consensus on earnings.
I think you're not alone. I think that's looking optimistic for a lot of people. Sri, we're looking at higher costs, maybe higher energy costs. We're looking at higher interest rates as well. Sri, I've been looking at the work you've been doing, and it's tremendously detailed. So forgive me that we've only got a few minutes to work through this. Just on interest coverage ratios, and typically how they respond as interest rates start to climb, how credit performs in a typical rate hiking cycle, and how typical this one isn't. Sri, can you run us through it?
Yeah, I'll try to be very brief. So the historical precedent of the playbook has been that coverage ratios do not really deteriorate early in a hiking cycle. So the logic here is that you do get that earnings momentum offset some of the increase in interest expenses, and that's why in the early part of a hiking cycle, what we have seen historically is interest coverage ratios improve, even for the leveraged loan market, where it's floating rate liabilities that we're talking about. What is different this time around, though, obviously, is the fact that, yes, the coverage ratio is probably for the loan borrowers, it's not really as high as it was kind of at the beginning of some of the earlier cycles, but it is a very healthy number that we're looking at. The key issue here is going to be the pace of rate hikes, and it's not necessarily around how quickly interest expenses go up. It's more to do with the fact that when do they start acting as a drag on earnings growth. And the concern here is that because you're looking at a Fed that's trying to control inflation, do they compromise on the growth outlook and create more uncertainty around the earnings outlook? I think that's the key when we're thinking about how coverage ratios evolve in this cycle.
When you think about that internally around the table at the moment, Sri, have you come to a decision, a base case with any confidence whatsoever?
No, a lot of debates, but I think it's still, what we are comforted by is the fact that the starting point is healthy. What we're debating is kind of how much of a balancing act the Fed can pull through. And to some extent, it feels like it's a little early to kind of conclude that corporate balance sheets are going to go through a significant downturn just yet. But we are aware that we can't just stay confident because of the starting levels being healthy. And there is also the nuance around, there's more debate around what the impact on the tail cohorts is going to be, because the portion of the market that is kind of over-leveraged and has relatively low coverage ratios, that is also kind of still on the higher end, which is why I think the be, the point would be that you need that earnings-related healing to come through, and we haven't really kind of come to a strong conclusion just yet. There's just more uncertainty for sure.
And that's where we are in this market, and that honesty, that transparency of those conversations at the moment is why a lot of people are finding it difficult at the moment to put money to work. Jack Caffrey, one way people have looked to protect themselves against higher interest rates, quite naturally, is just to buy the banks. The banks have done quite nicely year to date on the S&P 500, up about 4%, maybe not the gains you might expect. You talked about pulling back from the cyclicals. Let's talk about the winners of the year. Certainly not IT. Jack, it's been the banks, much more so in Europe at times, and it's been energy too. Can we sit on the banks just for a moment, Jack, and get your thoughts?
Yeah, I do think the banks are clear beneficiaries of higher long rates. And so to the extent that we are going to see the Fed try to engineer a yield curve shift, and I think the emphasis might be try to engineer a yield curve shift to try to indicate that they have better control over inflation, then I do think the banks continue to work. I think the challenge is going to be to the extent higher rates impact the housing market, and the housing market is a key driver of bank lending, the extent you don't really have a lot of corporate borrowing as of yet because of inventory problems. You just can't actually incur the inventory. The loan growth, I think, is going to be the question, and loan growth is probably going to be tied back to corporate and consumer confidence. And so ultimately, banks work, and they have yield, and they are doing the right thing, and they are well capitalized. But I do think that they're going to be, to some extent, the leverage play on confidence.
Jill, final word on that, just on the banks, please.
We've been overweight financials within both large caps, and then they've ranked favorably in our small cap work as well. I mean, I think they also fit what's another theme we think is going to work really well within the market this year, which is quality. I mean, typically high quality stocks with stable earnings, which financials has become an increasingly higher quality sector post-crisis. Those types of stocks are what works when you see the Fed tightening, when you see volatility pick up, when you see profits growth decelerate. These are all backdrops where quality works. And so within large and small caps, we would stick with an overweight on financials.
Jill, thank you. As always, Jill Carey-Hall of Bank of America, Jack Caffrey of JP Morgan, and to Sri Sankaran for condensing, I don't know, hours and hours of research on credit into about 2 minutes or so. Sri, thank you. As always, buddy, thank you very much. Your equity market's down about 0.2% on the S&P, 11, 12 minutes into the session. Some big movers, Abby, to talk about just after the opening bell. Let's do that now.
Big movers indeed, John. And one of them is Roku. Shares absolutely plunging down more than 20%, headed to the worst day ever since this company has traded publicly back in 2017. And it's interesting, they beat on profits, but they put up a 3% miss on sales. They also gave a disappointing guide. They're talking about issues with the supply chain. This is interesting only because 19% of their sales is from goods, whereas the rest is from programming. So it's hard to know how programming is affected by the supply chain. But in any case, the street is pretty bearish on this. We have some downgrades. Pivotal Research is now at a sell. They're saying that the bearish view reflects an increasing competition, a potentially significant weakening global economy. So there's a bit of a macro call there too. MoffettNathanson already at a sell. So a bearish day for Roku here. Not entirely surprising in some ways though, John, because ahead of today, this stock was already down more than 50% from its peak. So some investors were aware that there's weakness here. And it's really not even a bearish situation here from a short position, about 4% of the shares short. So just a brutal situation here for the shares of Roku, John.
It's a struggle in the early part of this morning. Abby, thank you. Coming up, Hong Kong, a struggle also, battling to get its COVID-0 strategy back on track.
In Hong Kong in early March, we'll most likely have many tens of thousands of infections.
That's next. This is Bloomberg.
in Hong Kong in early March will most likely have many tens of thousands of infections. I wouldn't rule out hundreds of thousands of infections that could be detected by this mass testing exercise. Where would those people go? Where would the cases be put? Because we simply don't have isolation facilities for that many people.
Hong Kong continuing to grapple with surging virus cases. The chief executive of Hong Kong, Carrie Lam, planning mandatory testing for all residents as China's COVID-0 strategy upends its return to normalcy. I'll bring back in Mike McKee for more here. Mike, we're testing all residents. That's 7.5 million people. It's a lot of people, a lot of work. Would you say, here's a part of the world that's a few months behind where Europe and the US was with this, and deploying a very, very different strategy?
It's more than a few months behind, John. You take a look at the chart, and it looks like Hong Kong is where New York was or Wuhan was when the whole thing first started. Nothing, and then all of a sudden this gigantic jump up, and that's what Hong Kong is trying to deal with right now under the strictures of China's COVID-0 policy. So they're going to have to make some decisions about how to do this. As you mentioned, they're going to try to test everybody in the city next month. They've already got cases leaking over into mainland China, so they're getting pressure from the Chinese to try to do something about this as quickly as possible. But you heard the doctor, tens of thousands of cases could be happening by the time they get around to starting testing. Then you bring everybody together in one place, stand in line to get tested, and you've got some transmission problems there as well. So Hong Kong facing some real problems going forward. Where are they going to quarantine? The doctor mentioned, well, they're talking about having them in hospitals or hotels that are converted to hospitals for 7 days. Then if they test negative, they can go home and quarantine for the rest of the time at home. But this is going to be worse than Wuhan, they say, because there's so many people that have to be tested at the same time, and the cases are already spreading very quickly.
Mike McKee, thank you, sir. As always, that's a really important story to stay on top of. If you've been following the price action, you know what's been going on. If you haven't, let me guide you through it. Just a quick chart intraday of S&P 500 futures. You see the pop late last night on the S&P 500 yesterday evening. That pop came about because we scheduled a meeting next week with Secretary Blinken and Sergei Lavrov, the Russian foreign minister. This came from Ned Price, a State Department spokesperson, who said the Russians have proposed dates for late next week, which we're accepting. That meeting will take place in Europe. Gains. Then we started to roll over. And this report came from Interfax, which I'll try and translate for you in just a moment. Separatists in Donbass turned around and said children, women and elderly people will evacuate to Russia due to what they called an escalation of conflict at the contact line. This came from a report from Interfax. We heard from the president of Russia a little bit later on. He went on to say that Kiev just needs to discuss the conflict with separatists. This was in a joint news conference with his counterpart in Belarus. The president of Russia said, I did not pay attention to invasion reports. Russia themselves, as you know, continues to deny any plans to invade Ukraine. But when those reports started to come out just a couple of hours ago, futures rolled over, turned negative. And here we are right now, unchanged on the S&P and negative on the NASDAQ. Let's get to Anne-Marie in D.C. Anne-Marie, can you translate those reports that came from Donbass separatists, according to Interfax, what that means, and whether we've had any response whatsoever from the U.S. administration?
So those reports from the leader of the so-called Donetsk People's Republic is about evacuating women and children from the region into Russia. Now, I believe TASS is also reporting, Jonathan, that President Putin thus far is unaware of this type of evacuation. But when you see a report like that, it does make you think, these are Kremlin-backed separatists, right? So it does make you think that there could potentially, or this could potentially be what the United States has said and been worrying about and flagging, that there could be a false flag operation. And we should note there is constant fighting in this region, although the last 48 hours, the OSCE has said they've seen an uptick in that. So that's what I would say in terms of what is going on in eastern Ukraine at the moment. Jonathan, just one point. When you read that headline that President Putin said he doesn't pay attention to the reports about what the United States says regarding Russian bill debt, I find that very hard to believe, given the fact you've seen his entire cabinet and administration come out and talk about that those reports are false.
AMH, a long weekend coming up in the United States. Over this weekend, as markets close on Monday, at least stateside, there's going to be some drills. Can you guide us through them, the kind of headlines, the stories you'd expect to read through the weekend?
Well, there are going to be drills tomorrow, and Lukashenko, the Belarusian leader, sat down with President Putin today, and they're going to be watching those drills tomorrow. I think it's important just to remember that these are technically military drills and exercises, and they do happen before. This is one of the biggest, though, we've seen joint forces between Belarus and Russia in Belarus, which geographically is concerning for Ukraine, because at the moment, what the United States is seeing is a buildup between 169 to 190,000 troops around that border. So I think just the financial markets will be closed, but this will, of course, have a lot of eyes on it, and you just have to really pay attention to all of the headlines. And Jonathan, it is going to be tit for tat in terms of the headlines between Washington and Moscow. I also believe I read that President Zelensky potentially, I think, is going to that Munich Security Council meeting. So it'll be interesting to see how many Ukrainians are actually not going to be in the country, because they're going to be meeting with European and Western leaders in Germany.
AMH, thank you. Looking forward to the coverage through today on Bloomberg TV and on Bloomberg Radio as well. All of this just keeping a lid on this equity market, for the moment at least. Unchanged on the S&P, just about positive on the S&P and on the NASDAQ. With your sector price action, here's Abby.
Hey, John. Well, there is that fractional gain for the S&P 500. Beneath the surface, it may suggest that that gain could grow because we have more sectors higher up top, communication services, as Netflix and Discovery really climb, maybe having to do with the Roku debacle. On bottom, energy down 0.4%. That's also the story in the week. Energy, the big lagging sector on the week. Most sectors down on the week as the S&P 500 heads to a second down week in a row, adding to that 8% decline on the year, the worst year since 2008. The year is young, but we also have the financials lower, communication services, and tech. So another brutal week for stocks here, John. And today, it's kind of right in the middle.
Hey, it's been choppy. Abby, thank you. Your trading diary up next. You know, despite all the chop, all the volatility, this equity market is down on the week, but only by a few tenths of 1% on the NASDAQ and a little bit more on the S&P 500. We turn higher now, 26 minutes into the session, by 0.25% on the S&P. That's the price action. Here's your trading diary. Fed Governor Waller, Chicago Fed President Evans speaking at 10:45. Williams and Brainerd to close out the week. They're the two to watch. Then the New York Stock Exchange closing for President's Day on Monday. US PMIs on Tuesday. Finally, US GDP and initial jobless claims next Thursday. From New York City stateside, enjoy the long weekend. A deep breath for you all. It's been a long one. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, February 18th. Here are the top market stories we are following for you at this hour. Twists and turns. Optimism over next week's Lavrov-Blinken meeting turns into concern over the Kremlin massing more troops and Ukrainian separatists evacuating to Russia. Stocks swing with the headlines ahead of a long weekend. Oh dear. The company works through supply chain issues and raises its profit outlook on strong demand for its big green tractors, but the shares give up gains. We'll dig into why. And under construction, how are higher rates and persistent shortages impacting construction? We'll discuss with Peggy Hogan-Marker of Marker Construction Group, and the latest housing data out of the U.S. is dropping right now. From New York, I'm Kaylee Lyons with Guy Johnson in London. Welcome to Bloomberg Markets. Alex Steele is off today. Guy, it is Friday. It has been another incredibly long week, and you are just a couple hours away from a vacation.
Absolutely. I'm very much looking forward to that, assuming that the weather allows anybody in the UK to leave their house, which at the moment doesn't feel like it. I'm not sure I'm getting home tonight with any ease. In terms of loving the big green tractor thing, fantastic. Love a tractor. We'll talk deer a little bit later in the program. Oh dear, also good. Kaylee Lyons really should be a rapper. Let's talk a little bit about what is happening here. U.S. existing home sales. You're talking about what is happening with the housing market. We'll talk more about this a little bit later on. The data, existing home sales bouncing back, rising 6.7 to 6.5 million. That's the rate. So the data confirming that we are seeing a continuation, Kaylee, of a very strong housing market. We have seen mortgage rates, though, going up and going up quite rapidly, and this takes us to the Fed decision, so we're going to need to think about that as well. You do wonder whether, to a certain extent, people are front-running that, but we'll dig into that a little bit deeper. Yes, I love the dig as well. Let's turn to our question of the day, and I have to say I've got a view on this. How do you manage risk over a long weekend? I think a lot of people, Kaylee, are conjuring with this as a problem right now. I feel that this is a market that has checked out. I think it checked out yesterday afternoon. I think a lot of risk got taken off the table. And today we're basically just kind of marking time, which is okay because it's a Friday and everybody's probably working from home. I don't know, do you feel like you've checked out today?
Slightly. As I said, it's been a long week, Guy, but also it's felt like such a long week because the headlines have been flying so thick and fast. Every time you look down, it's something new that has developed on the geopolitical front. So what is a market participant to do when there is still that much uncertainty out there?
Yeah. And I think uncertainty is the key word here. This isn't risk, this isn't manageable, this is uncertainty. It's open-ended, nobody's got a clue. So let's kick it around a little bit. Cameron Dawson, Field Point Private Chief Market Strategist with us. Romain Bostick, co-host of Bloomberg Markets The Close, also with us. Romain, let me start with you, just to get a kind of internal perspective on what is happening here. Yesterday afternoon felt like a bit of a capitulation moment. Everybody's looking forward to the long weekend. President's Day Monday. You've got a lot of geopolitical risk that you've got to manage. The market's incredibly whippy. I look at Roku today, look at DraftKings today. Time to check out, time to go home, time to take that position off.
Yeah, and you definitely saw that in some of the volumes, really, not just yesterday, but going back to Monday, Tuesday, Wednesday here. Those volumes continue to come down, not only on an aggregate basis, but on a single stock basis, you've seen them come down. At the same time, when you look at the activity in the options markets and how many people are gravitating towards put options, basically some protection to the downside, you do get that sense that people are willing to just walk away, maybe wait to see what develops with regards to Russia, Ukraine, and more importantly, Guy, to see what develops with regards to inflation and the Fed.
So, Cameron, after a dip like we saw yesterday, would you be comfortable buying it into the long weekend?
Well, I think you have to be very selective in what dips you buy, and this is where trend work becomes extremely important. We're willing to buy dips in areas where we're seeing oversold conditions and uptrends on both a relative and an absolute basis. But if you're talking about names that have been in downtrends, and a lot of these fall into that speculative tech area, if you're starting to see bounces, we would really be more inclined to sell those rallies. And so be very careful about the trends. You can buy oversold uptrends, but then you really want to be selling rallies in downtrends.
We talk about managing risk, Cameron, around a long weekend, but as we've just been discussing, there's a lot of kind of
unquantifiable factors around at the moment. So maybe a lot of people are just stepping back more broadly from the market. And that kind of brings me on to some of the individual stock price action that we're seeing. On my screen at the moment, headlines: DraftKings sinks drinks. Maybe I've got the weekend on the mind already. 15% at the open, and the biggest drop since March 2020. Roku drops 27% at the open, biggest decline on record. These headlines keep coming thick and fast. Individual stocks, even if they're missing or beating by tiny amounts, are getting whipsawed by this market. How on earth, as an investor, I'm not talking about as a trader, how as an investor do you deal with that?
I think you have to realize two things. The first one is that a lot of these individual stocks that are getting hit hard right now were the mecca of the really big, long YOLO option trading. And so it's one of the reasons why we can see such whippy trading, because those options positions are getting unwound. But the other thing that's important is that we think that investors need to be very appreciative of the fact that the liquidity environment is going to continue to tighten. And so as that tightens, there really isn't any appetite for high valuation kinds of names. So where you can reduce exposure to areas that are dependent on liquidity, you simply have to, and then rotate into more defensive areas of the market, whether it's in consumer staples or in utilities, as well as in some of those defense areas. We think that's a really cheap way to hedge out some of this geopolitical risk, mostly going into really big headlines. And so these parts of the market have been left for dead for much of the past rally over the past couple of years. So that's a fantastic opportunity to be able to add a little bit of safety within portfolios.
Romaine, I'm looking at the move for Roku. I'm listening to what Guy just said, and it reminds me that earnings season is still going on. We've been focused so much on these big macro issues of geopolitical risk, of Fed policy, inflation. Where has earnings season left us, especially when we look forward into the outlooks for the rest of the year?
Well, if you look at the micro, before we sort of got consumed by the macro, it actually wasn't that bad. I mean, most of the earnings that we got, at least for the fourth quarter, for that final quarter of the year, were relatively in line to above expectations. The bigger issue was with guidance. A lot of the guidance not only disappointed, some companies just refused to even give long-term guidance because of the uncertainty around there. And to Cameron's point about the liquidity in this market right now, this is going to become a much more of a bigger factor here with regards to what gets bought and, more importantly, what gets sold. This is just not the same liquidity environment that we were in, Guy, a year and a half ago.
Well, and let's just talk about what is happening, particularly with the options trade and what is happening there. These names, even on relatively short-dated calls or puts, the premium has gone up really quite significantly. How much of what we're seeing, particularly when some of these moves get going, is just basically the gamma trade, both up and down? Because it feels like everything's getting pushed around much more than it normally would have done. And with those big premiums, that kind of makes sense.
Oh, it's huge. I mean, the short gamma right now it's definitely going to drive today with the option expiry for the month here, and that's going to be a huge driver, particularly as we get closer to the closing bells here in New York. We've already heard from a lot of folks based on Bloomberg reporting. A lot of traders and dealers have basically said that a lot of these dealers have to follow that trade lower, basically where we were yesterday. So we could see more selling pressure based on that. I guess the question is, what type of trades then get sort of reset when we come back to work on Tuesday here in the United States after the holiday, and whether some of those sold off names have to then be bought back.
Well, and obviously, Cameron, it's a holiday here in the U.S. It's not a holiday elsewhere, and that brings me to kind of how the U.S. market is stacking up relative to the rest of the world. Given the heavy growth exposure, which obviously has come under pressure due to higher rates, is the U.S. equity market going to be able to hang in there?
That's a fantastic question, because we are just now starting to see better relative performance for non-U.S. markets, really for the first time in 5 years. And if we zoom out, we can see that international markets, whether it's developed or emerging markets, have been in very, very strong downtrends for much of the past 15 years. So we haven't seen a breakout in those relative trends to really argue that we should be moving to big, huge overweights in international and EM. But we do see that on shorter term trends, things are starting to look a lot better. And that is consistent with exactly what you said. These markets tend to be more value oriented, cyclical, old economy, don't have as much growth exposure. And that's helpful in this tighter liquidity environment. There's one last point that investors do need to be careful about, is that these markets do tend to be higher beta or higher risk, meaning that if we see a big risk off move in markets, investors investors are likely to dump these areas that do have more volatility over time. And so you have to be quite careful, choose your positions really carefully, but noting that this is kind of the first signs of life in international that we've seen in years.
Can I just take you back to that beta position and the fact that we could see volatility? Cameron, how are you thinking about hedges right now in the portfolio? What is acting as the dampener in your portfolios and the way that you're thinking about the way that the strategy should work here?
So that's a great point, because we actually are starting to see some traditional hedges within portfolios for big kind of spikes in volatility start to perk up. So that includes things like gold. So gold has been performing a lot better despite the fact that we've seen real yields move higher. That's really interesting because gold and real yields have been inversely correlated for much of the past 10 years. And so that could be a signal that there's some increasing demand for gold. And if we look at things like CFTC's positioning in gold futures, it remains kind of middling. So that's supportive of another move higher in gold as well. So that is the commodity portion of the hedging of the portfolios. And as I mentioned earlier, something that looks like more consumer staples, utilities, that kind of late cycle risk off benefiting types of areas are starting to see better relative trends. So we'd use spots like that in order to add some defense into portfolios and provide some downside protection.
All right, Cameron, stay where you are. Don't go anywhere. We are going to come back to you. Cameron Dawson, Field Point Private Chief Market Strategist. Romain Bostick is free to go prepare for the close. Make sure you catch him starting at 2 p.m. Eastern Time on Bloomberg Television. We're going to talk more about Deere earnings with Cameron in just a moment. The conference call is underway at the moment. They say they expect demand to outpace supply again this year as supply constraints continue throughout 2022. The stock is actually down now after initially gaining on its results. We'll dig into the reasons why. Looking at a big green tractor guy, this is Bloomberg.
To maintain the pricing.
Earnings season continues.
The Metaverse to Spotify to Qualcomm and beyond.
Bloomberg is fastest with the numbers and analysis.
Peloton becoming a proxy for this pandemic.
I think there's a tremendous opportunity.
Bloomberg, the fastest numbers and analysis you trust.
So the Deere call is underway, starting to get some headlines coming through from it. Basically, the indications are that the supply chain is going to remain a problem throughout the rest of this year, and basically demand is going to outpace supply throughout the year as well. That's a pretty good setup for Deere. Joe Doe has been following the call. He's just jumped off it to join us now. Joe, what are the highlights that you're getting so far?
Yeah, I mean, they're just kind of doing a rehash on the call right now, but they started to get into their broader outlook kind of 10 years down the line, which some analysts this morning were saying was actually quite conservative to what they should be looking at in terms of earnings and revenue coming up over the next 10 years. A lot of that is because the precision ag, which is basically the new technology that they're giving to farmers to more efficiently plant and to harvest, is just supposed to be excellent here in the near term and over the long term. I think if you're just looking at the report itself today, I mean, they raised their outlook on net income for the year, even though, you know, they took a hit from the labor dispute that, of course, many people might remember from the end of the year that didn't really wrap up until the end of November, which hit the first quarter. And also they're getting hit by the raw material inflation, right? I mean, this is what everybody's facing in the supply chain issues.
Well, and they say they expect the supply chain issues to continue throughout the year and that, you know, demand once again is going to outpace supply. How is Deere navigating that relative to some of the other peers in the agricultural industrial space?
Yeah, I mean, I think everyone's facing similar levels, but a lot of it might just come down to execution. I think in terms of the way their factories are set up, once everything's kind of back to normal, and that means they've got all the workers back in the right places, making sure that their supply chains, you know, just getting parts off shelves and making sure that, you know, the assembly lines are running correctly. They should be able to right-size some of this. But a big part of it is price increases, right? So to offset the cost inflation that they're facing, they're going to increase prices on their tractors to farmers who they think are going to continue to pay the higher prices, and that's because farmers are just seeing incredible demand for their products, for their ags, right? I mean, it's just been an incredible time over the past 2 years for them.
How many tractors do you need? How often do you need to replace your tractor? I guess we'll find out over the next few years. You wonder whether some of this is pulled forward. Joe, we'll let you get back on the call to continue the reporting. Thanks very much indeed. Bloomberg's Joe Doe joining us on the Deere call. I just want to step away from Deere for just a moment because Chris Waller is making some comments which I think are fairly interesting. Got a lot of Fed speak coming up. Chris Waller saying running the economy hot improves the job market for some demographic groups. Longer expansions improve the job market, particularly for black workers. Less advantaged groups seeing a better job market over time. So it's interesting what he's saying there, basically indicating that maybe actually this expansion hasn't fully reached the outer edges of the labour market and pulled people in, particularly the more disadvantaged within society, into the labour market. And this was always the idea about running the labour market and the economy hot, that you would ultimately reach those groups. But the labour market, as we see with the JOLTS numbers and all the other data, incredibly tight. It's represented as well in these Deere figures, as well as they continue to struggle with labour. Cameron Dawson, Fieldpoint Private Chief Market Strategist, still with us. Cameron, this situation for Deere, how sustainable is it right now? Joe making the point that the demand is absolutely off the charts right now. Is that something that continues? Do people just keep buying, do farmers just keep buying tractors and combines and whatever else they need as long as ag prices remain as high as they are?
That is the big question for investors from here, because it's how long does this ag cycle last? Ag cycles don't end when farmers can't get their hands on equipment, when they don't have enough equipment. Ag cycles end when they have too much equipment and they don't need to buy anymore. And so we see plenty of signs that Deere isn't able to keep up with demand. They're not able to build inventory. They're only producing to end retail demand despite going full tilt. They'd like to build inventory. Farm machine age is kind of on the older end. We're also seeing big, huge jumps in used tractor pricing. They increased almost 30% last year. All of that is indicative of still really robust demand for tractors and other farm equipment. But we have to watch farmer profitability really closely. So we are seeing crop prices go up. That's great for farmer incomes, but we're also seeing all the other input costs go up. So farmers have labor issues. Seed prices are going up. Fertilizer prices were up almost 175% since pre-pandemic. That's that's actually good news for Deere because Deere makes farmers more efficient. It allows them to do more with less, which is why demand remains so robust. And likely if we do see a down cycle, if prices for crop prices come off, it likely means that it's fairly shallow because farmers need this equipment in order to get the output at a very reasonable cost as much as they can.
Well, taking it beyond Deere and just the broader agricultural landscape, Cameron, obviously there is a lot of crops that are coming out of Russia and Ukraine, that region in particular where a lot of this geopolitical tension is centered. How do you view that risk?
So Russia and Ukraine are both major producers and exporters of wheat. Wheat's up about 8% starting this year, so it does appear that there's some kind of geopolitical risk premium being factored into wheat. There's a lot of exports that still need to go out from last year's harvest for wheat, as well as the idea that we would need to see imports of things like fertilizer and seeds into Russia and Ukraine, and that could get disrupted if we see an escalation in this conflict. Now, it's important to remember, though, as we go into the G7 meeting this weekend, that it's very unlikely that global leaders will want to go after some kind of embargo that could affect food prices. That's because food prices are at 10-year highs. They're up almost 50% since the pandemic lows. And they're at highs not seen since 2011, which was during the Arab Spring. So it really would be a Pyrrhic victory for global leaders to impact food supplies in any way.
All right, we have to leave it there, but Cameron Dawson, Field Point Private Chief Market Strategist, thank you so much for your time. Have a great weekend. We do want to get to some breaking news out of Ford. The Ford CEO, Jim Farley, is apparently mulling ways to run the EV business separately. We understand he weighed a potential spinoff of EVs or gas engine businesses. It is not planning to do so at this time, Guy, but once again, Ford CEO Jim Farley is looking at ways to run the EV business separately with his working on a strategy with his tech and chief field officer. So we will continue to monitor that story. Ford shares right now are higher in the U.S. trade, higher by the better part of 3%. This is Bloomberg.
About that all day yesterday.
Grayscale Investments hopes the SEC is listening to what investors want. Grayscale wants to convert its $26 billion Bitcoin trust into an exchange-traded fund, and it's encouraged investors to share their thoughts with regulators. More than 170 have now written in. Joining us now is Bloomberg's Katie Greifeld for this ETF Friday. All right, Katie, so the investors are writing to the SEC. Have we gotten any response from the SEC yet?
No response. So including every delay that the SEC can make, they have until early July to disprove this application. They don't formally reject anything, but they can stand in the way in early July. And so what this is, it's the biggest Bitcoin fund out there, but it's explicitly not an ETF. Grayscale wants it to be an ETF. Investors want it to be an ETF because this fund has been trading at a persistent discount to its net asset value for months now. And the thought is that it was an ETF. If it was able to actually redeem shares, then you might see that discount repaired. But until then, I mean, investors are kind of locked in here with this fund trading at a discount like it is.
Can I pivot to what's happening in the junk bond markets? Clearly spreads are widening, but this week has been a really busy week in terms of new funds coming to market.
Yeah, I mean, this is my favorite part of having this job is that some of the launches that you see are really, really innovative. And it seems like right now, junk bonds in particular are having a moment. You had State Street and Blackstone, they paired up this week to launch an ETF that's going to be half junk bonds, half CLOs. You don't have a lot of CLOs in the ETF wrapper, so to see this fund come to market is really interesting. You also have really a stable of BlackRock alumni. They launched 7 different junk bond ETFs this week, and what was interesting there was that these are sector-specific junk bond funds. Typically, you only really see that in equities. No one's really done it in ETFs yet, but now we have at least 7 on the market.
Katie, great stuff. Really interesting, as you say. Some fascinating things and innovative things being done right now. Bloomberg's Katie Greifeld. We need to talk about this Ford story. We're going to come back and do that in just a few minutes. The possibility of Ford E and Ford ICE being run as effectively separate businesses, I think is really interesting in terms of the potential, Kayleigh. You do wonder whether ultimately they could therefore boost the multiple that Ford trades on. Is that the objective here? And did he ultimately split the two? I don't know. It's a really tough ask. People have been asking that question to Volkswagen for a long time. We'll talk about real estate as well next. We'll try and figure out what is happening there. The data, again, strong this month. In fact, better than anticipated. We'll be back to that story in just a moment. This is Bloomberg.
an hour since the start of the U.S. trading session. Abigail Doolittle is tracking the moves. And Abigail, it's Friday. Steve Sosnick at Interactive Brokers putting it best. Today we learned how many traders are comfortable being long into a 3-day weekend.
Well put for sure. And right now, not so many. We have a small loss for the S&P 500, the NASDAQ 100 down more. So tech not doing so well, which is interesting only because we have yields down once again as bonds rally. So a bit of a risk-off feel. The S&P 500 right now heading to a second down week in a row. And you can see crude oil also down about 0.9%, adding perhaps to that risk-off feel. On the other hand, you could interpret crude oil as being a positive around the tensions between Ukraine and Russia. But nonetheless, again, it's a little bit of a risk-off situation going into the long weekend. And this is an add-on to the year. If we take a look at the year-to-date chart of the S&P 500, this sort of caught me by surprise earlier. This was, of course, true in January, but it feels like we've had some up days recently. But right now, the S&P 500 headed to a greater than 8% loss on the year. Now, the year, of course, is young, but if this were the end of December, it would be the worst year since 2008. That's the kind of decline that we're looking at right now, all of the volatility. And for some reasons to think that small cap may be leading the way down. That's a conversation for another time. But right now, we, of course, over the last few minutes have had some breaking headlines and, of course, a Bloomberg exclusive on Ford. Let's take a look at those shares popping sharply higher, a little bit off the highs. At the highs, up 4%, but nonetheless, up 3.4%. And, Guy, as you know, it has everything to do with Ford's CEO saying that they are considering ways to run their EV business separately, probably being prompted by Tesla being the behemoth in the space. Maybe wanted to take that on a little bit.
Yeah, there's one way of looking at the Ford bounce as saying this is down to the Ford comments that we've seen over the last few minutes. You could just blame Ed Ludlow because this is his scoop. It's a fantastic story. Let's talk more about it. Ed joins us now. So the idea here, Ed, is that they would run the business separately. And as Abigail alludes to, you got to wonder in the back of their heads whether they're looking at the Tesla multiples and thinking, I want some of that. Every auto exec I talk to, it's always the second or third thing they always talk about. How would this actually work in practice? What are they saying here? Because there seems to be some interesting disconnects in terms of the detail that we're getting here.
Yeah, that seems like a fair characterization based on what sources are telling Keith Norton and I. There are various mechanisms, right? They could literally spin off the electric vehicle business as a standalone unit. Sources say that's under consideration. They could spin off the legacy combustion engine business. But the net result is that you're separating the electric vehicle business from the combustion engine business, partly to get a fair value on the EV business. You know, according to sources, Ford had already spoken to bankers and consultants at the end of last year to think about how they could raise money. Because as you know, Guy, we'd already reported that there's this ambition to upscale their investments to about $50 billion. They've got 60 production facilities around the world, and it takes a lot of investment to change those assembly lines from gas engine assembly lines to ICE. That is some of the options that are on the table, as well as just simply restructuring internally and just running them as two separate businesses under one name.
Ed, where's the Ford family in all of this?
Yeah, fantastic question. The Ford family have 3 board seats, as you know. They have a special class of stock that gives them significant voting power. Sources tell us this is a sticking point, that Farley is kind of chopping and changing in his own mind between all of the options which are on the table, but whichever he goes with and whichever Ford choose, they're going to have to get it past the Ford family, who sources tell us have some reservations about a significant change to the status quo.
Has anybody done the maths on what a standalone Ford E business would be worth?
In short, no. I think that's part of the interesting question, that they perhaps potentially could raise money at a higher multiple if it was just based on the EV business. What we know is that Farley and Ford have already dramatically ramped up their production of the 2 products they've got, right? The Mustang Mach-E and the Ford F-150 Lightning. The demand for those 2 vehicles was much more intense than perhaps they expected, but they're still younger businesses. There isn't as great a visibility into profit, for example, but there probably is a great visibility into future revenue streams. So, you know, that's part of this. They take a look at Tesla, at the multiples Tesla trades at, and also Tesla's ability to tap capital markets for financing, right? Tesla has done various financing mechanisms. They've raised money at a cheap cost of capital. And I think, as you said at the beginning, Guy, maybe Ford wants a piece of that.
Speaking of different competitors, Ed, we have an IB question coming in from a viewer and terminal user. GM's head of Cruise, as we know, left the company earlier this year, and it appeared the issue may have been about spinning off the EV business. How universal is this problem?
Yeah, it's an interesting point. I think Guy is right to ask questions about unlocking value. These are incredibly capital-intensive enterprises, right? And in Cruise's case, GM was committing $1 billion a year to fund that business. At the same time, GM's trying to manage its own transition. This is the principal difference between Ford, GM, and Tesla. Tesla starts from a clean slate where it only makes electric vehicles. GM and Ford are having to transition while maintaining profitability of their best gas guzzlers. And GM was putting $1 billion into Cruise each year. By spinning it off, it could potentially stand on its own 2 feet, but also find a more fair valuation that will allow it to raise funds while giving investors kind of this look to the horizon, because as we know, these are technologies and business models that are far from being revenue generating, let alone profitable.
All right, Ed Ludlow, congratulations again on a fantastic scoop. Ford shares are moving in a big way off the back of that, up about 4% in the U.S. session. Thank you very much for joining us from out in San Francisco. Now let's get back to the data we got at the top of the hour. Existing home sales showing they rose 6.7% in January. Inventory is still a problem, and home builders can't keep up with demand. Joining us now is Peggy Hogan-Marker, president of Marker Construction Group. She is in Fort Lauderdale, Florida, where I'm sure it is a lot warmer than it is in London or New York, where Guy and I are. Peggy, thank you so much for joining us. Obviously, the housing market is booming, and it has done so in an environment where rates have been quite low. As we see mortgage rates moving higher, what is your expectation about what it's going to do to demand?
Honestly, I don't think it's going to affect demand. It's so out of control right now in South Florida. We had a 142% increase in Miami-Dade County and home sales this year. So there's such demand, not only from in the United States, but also from out of the country, that I don't think it's going to make a difference. Most of these people are cash buyers.
Peggy, is this a broken market? I ask that question because I'm looking at the availability of supply, and it looks really limited at the moment. People aren't moving because they can't find anywhere to live. At that point, the market just grinds to a halt. How close to that point are we?
I don't think we're there yet. I think the money that's coming in for your house right now is so attractive that even when people don't have a place to live, they'll relocate, within the state. They'll move to a different county or whatever just to kind of cash out. It's insane, the numbers that are being offered.
Well, what else has been insane is some of the supply side challenges we have seen, Peggy, everything from materials to labor. How acute are they still? What are you seeing on the cost pressure side and the shortage side?
Yeah, it's very acute. It's starting to stabilize a little bit as far as the numbers that we're paying, but it's not going down at all, and the supply shortage is out of control. We're seeing, a year on appliances, a year on roof. Things are just holding up. The market's like really kind of grinding to a halt as far as being able to effectively do a project.
So what needs to happen here, Peggy? We're clearly in a situation where the Fed is looking at what is happening here, looking at asset values, looking at a housing market that may be encouraging people simply to step away from the labor market because they're making so much money from selling properties. Kind of the property market is supporting that idea that they don't have to work anymore. What needs to happen? Do you think, would you welcome higher rates, maybe to slow things down at this point?
It wouldn't be a bad thing, honestly, like to slow things down and try and stabilize the market. You hit on something that's really a massive problem in our industry, which is the labor shortage. There just are not enough people to do the work, to do the projects, and the demand is out of control, and it's jacking up prices even more.
And Peggy, obviously we've talked a lot about the residential space. What are you seeing in the commercial sector?
Commercial sector is really interesting. It's actually the same kind of thing. There's a very, very high demand for rental properties, for condos. We're seeing not only the traditional big developers down in South Florida, but there's a lot of people coming from out of state and out of the country that are just doing 1 or 2 projects and starting to dabble in the field because it's so profitable and the demand is so high. South Florida has unbelievable growth.
Peggy, come back again and talk to us in a few months' time, maybe in a few weeks' time. This market sounds like it is, as you say, really, really hot right now. I'm really fascinated to see kind of whether or not this is sustainable. So come back again soon. Peggy Hogan-Marker, Marker Construction Group President, thank you very much indeed. Talking of supply chain shortages, we are certainly seeing that impacting GE right now. The stock is coming under a little bit of pressure. We are seeing that right now. This is the company update saying that the supply chain woes may pressure profit in Q1 and in the first half. We are going to continue to monitor this story. We've got some great specials coming up actually on the supply chain issue. So make sure you tune into Bloomberg Television for that.